with a tool that they know that they can use to present to clients. And number two is you come away with, oh my gosh, this client, this client, this client, and come away with ideas that are like, I need to go with them with this idea. I need to go to them with this idea. And that's how, one, you help clients, and two, you draw revenue from activities like this. So this is a smaller group, which means we can participate. I'm going to be asking questions. If it's dead air, I'm going to wait. We got to participate because this is what this is for. This is coffee talk, not coffee lecture. So let me open this up and share my screen. The entire thing. All right, can you all see my screen?
Am I is there like cameras or anything that are just disabled?
I
don't know if that was something that in setting up the meeting.
So can you see my screen or no?
No, we can't see your screen.
Okay. Let's try. I'm sharing entire screen.
No, nothing.
Nothing yet. Okay, thank you. Let me try sharing a window.
Can you hear us?
Does this work?
There we go.
Yeah, that's good.
Boom. All right. Thank you. Love it. Let's do this. Okay. Rock and roll. So, helps if I start at the beginning, not in the middle. That wouldn't make sense. All right, y'all. 3 things. The revenue gap. This is the client approved presentation. Number 2, talk about some numbers real quickly, and then legacy done right, which is the idea that you're going to use to go back to clients and help them out with what we learned today. Lots of disclosure. You know why there's lots of disclosures? Because it's a client approved presentation. So you guys know this stuff. There's nearly $38 trillion in retirement plans, and that number is only growing, right? That's our big opportunity, is to help folks with this stuff. Most of it is in IRAs and 401k. So if you told a client, you know, what percentage of your retirement income is going to be taxable, what are most clients going to say?
None of it.
Yeah, all of it, right?
Nothing we can do about it.
Yep. No, there. Oh, that's a better answer than I was going to say, right? A lot of this is a taxable future. So there's 2 different types of tax curveballs that can come to our clients. There's situational and there's legislative. And again, think about this as something, if you do a client appreciation event or you do seminars or you just do webinars for clients, this is something that you can talk with them about. So situational examples are like the widow's penalty or the 10-year tax trap. For the widow's penalty, if you have a client who with $100,000 income and they're married, at least federally, it's only 11.3%. What happens when the spouse dies?
You lose your marriage, whatever the income limit goes down.
That's right. That's exactly right. So assuming the same income, it goes up to 16%, which is a 42% increase. And across all tax brackets, that's why they call it a widow's penalty, because usually it's us dudes who die first. It's not fair, but that's how the tax code is written. And if they don't have a plan, this is what happens. And what am I referring to with the 10-year tax trap? Any guesses?
This was something that pull it out in 10 years.
Yeah. No more stretch IRA.
Take it out in equal amounts, and they kind of forget it. They got to take it out in 1 year, and bam, now they're in the 50% bracket.
Yep. And if they don't have an advisor watching out for this, what you said is what happens, right? No one's paying attention, and so there they go. So when you make your regular income, it's a tiered rate. Your first dollar actually isn't even taxed, and it grows to whatever your tax bracket is. But for your IRAs that you inherit, 100% of that is all at your top marginal tax rate. It doesn't start at once. So that's the IRS is taxing your inherited IRAs at the top marginal tax rate that they can. Now, legislative changes. This is a one. By the way, the federal Congressional Budget Office puts our entire budget on one page. So our budget, our total revenue is $4.9 trillion. That's how much we pull in as a country in revenue. Now we have mandatory spending. That's Medicare, that's Social Security, and the total cost for just those two programs is 4.1 trillion. In addition to that, we do have some national debt that we have to pay our bills on every year, and that interest on that debt is 0.8 trillion. Last I checked, 4.1 plus 0.8 equals 4.9. So between our two mandatory spending and our debt, we're covered, right? We're good. That's a good household. What's missing?
All the other spending.
Yeah,
Yeah.
we mean
Everything else.
everything else.
We're forgetting about Sesame Street and Iraq. That part.
Oh my! See, that's why you guys are the advisors. The Sesame and Iraq, Sesame Street and Iraq presentation. So, if think about doing this in front of a clientele, when you ask what's missing, all of a sudden their brains start turning, right? We talked about Medicare and Social Security, and that's it. So the rest of it's discretionary funding, like Iraq, defense, Department of Transportation, schools, everything else, police, fire, all that kind of stuff. Our discretionary money is 1.9 trillion. So the total is we spend 6.8. So as a household, that's good, right? We're fine. Okay, that's a problem. We're spending a lot more than we're making, and percentage-wise, that's a huge difference, right? So in 2024, our total debt was 35.5 trillion. Anybody know what it was at the end of last year?
32.
I think we're at like 38, 39 now.
Wow,
last
look
year,
at you.
the year before. Yeah.
So So it did go up from 4 to 5. Yep. So I haven't even looked whether we hit 40 yet, but so that trend, that the interest we're going to pay on our debt is going to probably go up. So how do we align our income and expenses? What tools do we have as a nation to do that? So mandatory spending, that whole mandatory part, it's law. So we can't really change that part. And if we did, Congress would have to vote to cut Social Security or cut Medicare. And if you want to get reelected, that's a problematic thing to do. Even though that might be what we have to do, we keep kicking that can down the road. By the way, our population is growing, so our need for costs for Social Security and Medicare are actually only going to increase. Net interest on the debt, like you guys saw where the debt's going. So ironically, what I pulled out of here, our national defense, we pay more every year paying on our interest on our debt than we do on our defense. Yeah. So go ahead.
It's depressing.
It's depressing. It's depressing. Well, look, you guys are in the business of solving problems, right? But if they don't know there's a problem, all right, so that's not going to go down. All right, discretionary. Well, half of our discretionary is defense. So it's like 13% is discretionary, half of it's defense. So the other like 6.5% is everything else. So everything they argue is over 6.5% of the budget. So if we can't reduce our debt and we can't reduce Social Security and Medicare because it's the law, and we can't reduce our spending, we got to increase what?
Taxable income.
Yeah,
Revenue.
taxes, right? So how do we change? They can change tax brackets. They can change the amount of income applied to each tax bracket. They can change what you can deduct. We used to take a SALT, state and local income tax deduction in California. Now that's been limited. Or they're going to come up with new and adjusted income-based fees. This is actually that fourth button. That's what a lot of Congress is working on. Or they can change how and when assets are taxed, like that 10-year rule. All different ways that they can do this. So, gosh, that's really scary. If there were only someone who could help me navigate this and make sure when I retire, not 100% of my income is going to be taxable and I'm fully exposed to whatever tax rates are going to be in the future. That's perennial. That's you guys. You come in with the cape. So again, all the stuff we went in before, this is all client approved, and I will send this to Dane and Miriam so you guys have this. Obviously want you to use it. It's a great setup for whatever you want to talk about next that has to do with tax planning in their retirement or other plans. So quick aside for like 4 slides on regional numbers, then I'm going to get into what we're going to apply, how taxes make sense, and how to mitigate some of that in our legacy done right. So you are part of the Southern California region, even though not all of you are in Southern California. We appreciate you being here. We're Midland National. We love being partners with Perennial, known you guys for years and are friends with many of you. As a company, Midland wrote 6.5 billion. You guys wrote 6.5 billion of insurance last year, paid out 1.2 billion in death benefit. Illness benefits are now coming in because people are getting older. We've had those long enough. As a region, this is specific to Perennial. As a region, y'all wrote 700 million in death benefit, and I get to see all the death and illness benefits that are paid. We paid out 150 million in death benefits. By the way, when there's an advisor involved, that money stays with the family. You made us the #1 region for total policies written and the #1 region for target premium. And we've got bigger goals next year, but y'all make a difference. These are real families that get helped. You see on the lower left-hand side, Midland pays 34 claims a day. None of us make it out alive. So thank you for thank you for having a life insurance conversation. Thank you for using Midland National. Thank you for putting it with illness benefits, because those are starting to come through, whether it's, by the way, terminal is the most common, then chronic, and once in a while there's critical. But you change families' lives. You allow them to stay in their world when they need it most. So thank you. And if I didn't say it before, thank you again, because you made us the #1 region and we appreciate you. If you haven't yet written your first case with Midland, let's go. Let's do it. Let's do it. Let's do it. So I'm going to give you an idea. Go ahead.
Mike, there in the bottom it says for agent use. Is that just for this last part,
Yeah,
the region part, but prior to that is good for clients?
Correct.
Perfect.
Correct. Yeah,
then if you'll
the regional numbers
CCT,
part, that's not approved.
If you'll CC Tia on that too, and then Miriam and I, then Tia can upload it in the portal for all insurance agents to have access to it, so they can go like pull it at any time into that file. Awesome. Yeah. Thanks.
Rad. Yeah. Want you to have that. All right. So we talked about the inherited IRA. All right. Now is your job to make money. Take this information and run with it. So inherited IRAs. We talked about the rules. What are the problems with inherited IRAs? Is you got to take it out within the next 10 years. So it's due within 10 years. It might increase your entire, so it's not just your taxes on this money. It might throw your whole income into a new tax bracket, right? I mean, you don't have a choice. You can't just defer and defer and defer. If you're on Medicare because your mom and dad was 85 and you're 60 or 65, 65, you might have an increase in your IRMA fees because of that. And if you don't pay attention because you're not working with a Perennial rep, you're going to have penalties and deadlines that often get missed, right? We know the problem here. So what's the problem with the inherited IRA is there's no leverage there. If you leave money, one of the worst things to leave from a financial standpoint to your beneficiaries is qualified money, right? There's no leverage. It's a hassle to manage it. If they don't have a Perennial, it's an account, it's not a contract. So who knows what that's doing? Mom and dad set this up, but the kids don't know what's going on. And what about for you guys? If it's left in a qualified account, it's really a missed opportunity to connect with loved ones and keep those assets under management, right? And if there's no leverage, because the IRS takes money out, there's less proceeds to reinvest. So what do clients want for their legacy money? Not a trick question. A lot of this has to do with, are you asking the question, right? So one, they want to fire the IRS if they can, right? How do I do that? They don't want the hassle of this. They don't want their tax bracket to increase. They don't want IRMA surcharges to go up if they're taking Medicare. But if you inherited qualified money, this is what happens. You guys all know this stuff, right? So what do clients want for that? This is what it's about. Why do you leave money for the next generation? It is for family, right? So I just told you the worst thing to leave for your family is a qualified account. If only there were better solutions, right? Darn. Good thing we're at Coffee Talk today. So, by the way, what is IRMA? IRMA is basically a surcharge on your Medicare. If you have certain tax brackets, you get to pay more. And inheriting an IRA is one of the classic ways people get bumped into having IRMA surcharges. So, gosh, what if there was just this special contract that instead of turning $1 into 70 cents, it turned $1 into $2 or $3, and it fired the IRS, and it allowed me to take care of my family, and it didn't bump up my tax bracket, and it didn't bump up my IRMA surcharges. What would that contract be called? Any thoughts?
Life insurance.
Oh, I love you. Yeah, what? Yeah, life insurance, right? That's what, like, there's all these sexy things that we talk about with life insurance, and I swear the next coffee talk we're gonna go back to it because I love that stuff. Tax-free income and all these, and how the indexes work. But life insurance is a tax-free leveraged death benefit. It is the most efficient way to move money from one generation to the next with leverage. Yeah. So here's what we're going to do. We're going to identify funds in client IRAs or qualified money. We're going to structure them into a life insurance policy based on our tax projections. We're going to select a funding period for life insurance policy. And this is where I want you guys to pay attention. So there's different ways to do this and then present to the client. So these are our 4 steps. So legacy done right. Here's our client. I picked the most Des Moines, Iowa, Sioux Falls, South Dakota looking couple I could find. 2 million in IRAs, and the numbers don't matter, the concept does. 2 million in IRAs, let's say they're earning 5% on that. 500,000 is earmarked for the next generation. Probably shouldn't be in an IRA. Their current tax bracket is 19.3%. We're going to bake in, hey, tax brackets are probably going to go up in the future, and their kids are in a 25% tax bracket. Again, the concept matters more than the numbers, but here's our setup. And we're going to say they're 65 today and they're going to live to 95. So this is a 30-year plan. So if they have 500 in IRA that's intended for the next generation and they do nothing, by the way, that's the best perspective question/comment that you guys give, which is like, well, what would happen if we did nothing? So 500,000. They live to 95. They're going to pay RMDs, right? So the RMDs on this account between now and 95 are going to be 187,000. And they're going to reinvest that because they're not using it. So there's another 52,000 on top of that. And then their beneficiaries on 25% tax bracket. So when they inherit the money, it's 139,000. So the total taxes paid on this 500,000 IRA is 378,000. If you show this to a client, what are they going to ask you?
How do we decrease that, or how do we get rid of that?
Yeah, I thank you. Exactly right. And I think the trick to that is showing them the numbers. And if you don't use Stonewood is a software you use, there's lots of different softwares financial advisors use. This is the one that we use. If you don't have an easy way to do this, we can run this report for you on any qualified account. But it is important to show them, hey, what are the total tax? If we do nothing, if you don't have a plan, the IRS has a plan for you, right? So let's convert this IRA for legacy. So we're going to reduce taxation because we're going to suck it up, Sally. You guys do Roth conversions, the same idea. We're going to suck it up. We're going to pay taxes now. We're going to eliminate RMDs moving forward because we're moving it out of an IRA, a traditional IRA, a qualified plan. We're going to eliminate any chances of our IRMA surcharges from age 65 to 95. And we're going to reduce the income tax bracket because now we're not going to add this onto our beneficiaries' tax brackets when they inherit this money. So, like I said, suck it up, Sally. You're going to pay taxes on the seed or the harvest. This one, Mr. and Miss Client, we're going to pay taxes now. We're going to fire the IRS after that, and all future growth goes to your kids or your charity or whatever your beneficiary is, right? To what's important. So we got this one. So, do we convert to a Roth or do we convert to an IUL? Let's play a game. Why would we convert to an IUL instead of a Roth? I've got 4 answers. Let's see what you guys come up with.
Leverage.
Leverage. Okay. What else?
Defined number. In other words, this exact amount goes to them.
Yeah, I love that. It's a contract, not an account. Some certainty. What else? Why would we do an IUL over a Roth?
Chronic illness rider.
Ooh, illness benefits.
No downside, market participation.
There you go. Man, you guys are good. All right. Let's see. Let's play our game. So, legacy done right. Advantages of a Roth conversion over or a advantage of an IUL over a Roth conversion. Excuse me. Easy for me to say. That's why I'm not the game show host. So number one, no break-even risk. Because if you pay taxes today and you die tomorrow, your family might get less because you might be in a higher tax bracket than your beneficiary. So if you do a conversion into a Roth, you have to live long enough for that to grow back to make sense. Number two, survey says immediate tax-free legacy. You guys nailed that one, right? No waiting for growth. Day one, you get that death benefit. Next, survey says illness benefits. You guys got that one as well. Terminal, you can access up to 90% of the death benefit up to $1 million. That's the most common one because of the big C, cancer. Number two is chronic. You can access up to 24% of the death benefit per year up to $2 million. That's same qualification as long-term care. Can't do 2 out of 6 activities of daily living or cognitive impairment. Number three is critical. But in that case, you probably wouldn't use that. You take out of the cash value first. But you do get illness benefits, and if you convert it to the Roth, there is no leverage for illness benefits. Last one, survey says, Dane nailed this, guarantees, safety, certainty. Peace of mind is a real thing. I want to walk out of my appointment with you knowing exactly what it is, what the plan is, and how much my family's going to get. And you can give that to them. So you saw the numbers on the left. If we reallocate this to tax-free, we're going to look at 2 ways to do that. We're going to convert this over the next 5 years. That's 500,000. We're going to convert it 100,000 a year over the next 5 years, or we're going to put it in an annuity with a guaranteed lifetime income benefit and convert it over lifetime. So these numbers are the first numbers. If we convert it over the next 5 years, 100 grand, convert it into IO over the next 5 years, we are going to pay taxes now. So if we have 500,000, 96,500 is going to go to taxes because we're sucking it up and we're paying out. So what about
Mike, is that on the full 500 and it just in 1 year converting the entire amount?
Thank you. Now this one I did because I didn't want them to take a huge income bracket jump in year one. I spread this over 5 years. So it's 100,000 extra a year over the next 5 years.
Gotcha. Thank you.
And that's over that 19.6% tax bracket. So close to 20%. It's close to 100 grand in total taxes. How much do they pay in RMD taxes moving forward?
Upkiss.
Yay, I love that word. And how much do their beneficiaries pay when they get the death benefit?
Zippo.
Yeah. So total taxes, 96,000. Last time I checked, 96 is significantly less than 378. On the left-hand side, ladies and gentlemen, we have the IRS's plan. On the right-hand side, we have the perennial reallocate to tax-free retirement right, legacy done right plan, right? So this is a Stonewood report. If you guys use your own software, great. If not, we will run this for you. I suggest, I'm not part of Stonewood. They do software that helps people sell life insurance and annuities. Even if you never subscribe to their stuff, I would hop on their mailing list because they send out some good materials for advisors. I like their stuff. So how do we move it? We got 2 different ways. We can either do a 5-year plan, so we spread it out, 500,000 going in, 100 grand a year for the next 5 years, or we can put it in an annuity with a guaranteed lifetime benefit. Let's take a look at the difference. So case study, 5 pay versus lifetime pay, IRA to IUL conversion analysis. So one is not better than the other. They're just different, which is why you're here, right? Is to learn the differences so you can figure out what's best for a client. My suggestion is you never give a client a choice to something that they're not going to be able to make a decision on, right? Maybe some of this is you just decide for them because you know their situation and you know what's best. So if we do the 5 pay, it is easy. Sure, the next 5 years, we're going to convert it over and we're done. But because we're moving it over the next 5 years, it does have the highest initial taxation. Tax drift, it might temporarily push them into a higher tax bracket because we're adding 100 grand onto their income. but there's less exposure to future tax rate increases because if taxes go up in the future, they paid it now when tax rates are likely going to be the lowest in their lifetimes, right? So there's our 5-pay scenario, pros and cons. If we spread this out over lifetime and we put this in annuity and use a guaranteed lifetime income benefit and use that to fund the IUL, the life insurance, that will have the lowest annual taxation because instead of moving 100 grand over, it's going to be less because it's a lifetime payment. But over time, and again, we're assuming these guys live to 95, they're going to pay the most in total in taxation. Again, perspective, both of these are much better than the IRS's plan. Let's look at that 5-pay first. So remember our Midwest folk, our classic white people, here's their situation. We're gonna move 500,000. You guys saw before, if they do nothing, the IRS's plan is this. If they convert it to tax-free, then the number is this. For a lifetime pay, this is the same number for the IRS, the do nothing number. Because we're spreading that $500,000 out over the next 30 years, and we're going to earn I showed 5% interest growth. And if you do better than 5%, this number would be higher. It's more in taxes, right? And that works whether you convert it to a Roth or an IUL. 284 is still a lot less than 378. If they have more zeros after this, that just makes it more important, right? So if we're just talking about an IRA versus a Roth IRA, if you convert it at 65, we talked about that break-even risk. How long does it take for the Roth IRA to catch up? And that age for these clients is 72 if they're earning 5%. So that's a 7-year catch-up. After that, converting to a Roth makes sense. Absolutely. You fire the IRS, you pay taxes today, it's going to be more for my beneficiaries. What about life? If we do a 5-pay for a 65-year-old male, standard health, 100 grand a year. Sorry, 100 grand a year is what they take as income. His total premium is roughly 400,000 because 100,000 of that 500,000 went to taxes. What do you think $400,000 in premium gets us for a guaranteed death benefit for a 65-year-old? 400,000 premium. What do you guys think? If you're giving
1.2.
Okay, thank you. Thank you. If you're giving a presentation, the rule is 7 seconds. You wait 7 seconds to give people a chance to think and speak. We were like at like 8. So thank you for that.
I was
Pretty
muted,
good
so
guess.
I tried answering earlier.
Thank
I
you.
forgot you did myself.
Thanks for playing. Thanks for playing. So the life insurance, well, before I give you the number, because that's a very intelligent, educated number that you guys just gave me. So the death benefit, reminder, death benefit is tax-free. Death benefit is immediate, day one. The Roth IRA is not immediate. Life insurance contracts are going to be protected from future legislative changes for, like, who knows what happens with the Roth IRA, right? We'll see. We'll see. So life insurance, 1.2. High five, fist bump. That was a really good guess. So roughly 1.25 million. Completely tax-free, guaranteed day
And
one.
Micah, this was a 60. What was the age of the person that we put the
This
400
was
in?
65-year-old male standard.
Okay.
That's pretty darn good leverage. Now, tooting our own horn, it could be less than that if you use any other company than Midland National, of course. And in all seriousness, we do have the most leveraged, least expensive cost of insurance for guaranteed death benefits right now, whether it's a lifetime pay, a short pay like this, or a single pay. At the moment, we're kind of untouchable, and it comes with illness benefits too. So
what specific policy was it on this one?
Yeah, thank you for bringing that up. I think I have that coming up.
Okay.
Little sidebar, and if not, I'll answer it in a moment. I just don't want to steal my own thunder. Oh, we do. So I'm glad you asked that question, Dave. Strategic Protector. So we have 3 different IULs, and each time we come to Coffee Talk, we'll highlight one of them and when to use it. But this one is for guaranteed death benefit. You can dial the guarantee all the way up to 120. This one, I think this was, they lived to 95. You can guarantee it to 105 or 100 or 96, whatever you like. extremely competitive. That fourth bullet point, if well, actually I think I go over that. Premium recovery. We're going to talk about that and illness benefits. So what if? Oh, I do. Okay. What if? All right, I want to give this money. You're my advisor. I want to give this money to my son and my daughter. What if my son turns into someone who I don't want to leave all the money to anymore? Or what if my daughter ends up having a different plan for her finances and I change my mind? Yeah, not compliance, or not agent approved only on this one. If they change their mind of who their beneficiaries are, our protector has a premium recovery endorsement, which basically says at years 20 and 25, this is the exact scenario we talked about. The 1.27 million, 403,000 went in, 403,500 because the 96,500 went to taxes. You'll see that in years 20 and 25, even though there's no cash value, because we're leveraging the most amount of death benefit possible, there's a kind of a springing cash value. If I wanted to walk away year 20 and 25, I could cancel the policy and get all my premiums back and do something else. Most people don't use this, but it is there. And for a client who's not quite sure of their future or their beneficiaries, this actually adds some solace. So this was obviously, we talked about what's good for them. Why is it good for you guys? Because let me tell you, if they don't meet with the advisor, this money stays in that qualified plan. The IRS has a payday. Clients' goals don't get met. Beneficiaries' goals don't get met. And the advisor doesn't have compensation that exists. So we don't exist without you. There is, if anybody didn't know, we do pay advisors to help us with distributing life insurance. So this one had a 26,000, roughly 26,000 in target premium. But because it's 400,000 going in, there's excess premium. So you get paid on the excess premium as well. We do pay renewals for 10 years. Now this was a 5-year premium. So we can get renewals for 5 years. And we do pay asset-based trails, almost like a 12B1 fee. Every year that you do a penny more than you did the year prior, there's a consistency bonus as well, as long as you did at least 25,000 with us. In total, this is roughly 50,000 in GDC, target premium, whatever you want to call it, revenue, in gross revenue by the 20th year. So I include 20 years of trails in there because Midland is unique that we pay asset-based trails. Let me tell you, you turned what was going to be, 300,000 for this family into 1.25 million. They do a lot better than you do, but the advisor does well too, because we don't exist without you. So let's talk about lifetime. We did a 5-pay, right? We're going to move the 500,000 over, 100,000 a year over the next 5 years. Lifetime pay. All y'all, good Midwest concept, sell annuities. Annuities have potentially, some of them have guaranteed lifetime income benefits. If you work with Midland, and I don't care, but Midland does have some extremely strong guaranteed lifetime income benefits. Generally speaking, between a variable annuity, an index annuity, and a fixed annuity, fixed index annuities, Midland or otherwise, tend to have the best lifetime guaranteed income payouts. It does not matter which annuity you use. But if you use a Midland one, we automatically move the money over from one pocket to the next. So these same clients, 500,000 a year mark for legacy, their guaranteed lifetime income benefit at age 65 with Midland would be $34,000 a year for the rest of their joint lives. They're in that 19.3% tax.
That's a joint payout based on
It is a
265
joint
years.
payout. Yep. So, oh, I lied. It's not joint. This is individual. Now, hypothetically, Dan, you brought up something. I think that's might be why you're asking. It could be joint. So it pays for the life insurance, and when dad dies, mom still has an income. It would just be less death benefit, right? But that certainly could work. This one, we're going to leverage it all. We're going to put it on dad's life, and we're going to give it to the kids. Because, again, this was in dad's IRA, dad's 401k, dad's 403b. 19.3% tax bracket. So 34,000 minus 19% for taxes is 27,500 in premium. That's our annual premium for this. And it's a self-funding plan. You put the money in the qualified IRA with the lifetime income benefit. Every year, 34,000 comes out after taxes. It's 27.5, and that goes into the life policy. If you do everything with Midland, we do that automatically. If not, you just have to administer that, right? Where the annuity sends the money directly to their policy for an annual premium. It is clean. It is clean, clean, clean. So for this one, I'm going to use a different product just because I want to talk about a different product. So our accumulator is our flagship IUL. It's #1 in the industry for income in most scenarios. It's an index chassis. So when the market goes down, if you use SP 500, that's actually got a floor of 0.25. Not, we say 0 is your hero, but in this one, it's 0.25 is your hero. After year 11, there's a 50% or 50 basis points persistency bonus, which helps offset insurance costs because not every year the market goes up. And we do charge insurance costs every year because you want us to pay that death benefit. So this is a very strong chassis for your larger cases, your business insurance cases, your premium finance cases. That persistency bonus adds a lot of security and resiliency when other IULs don't have that. Full illness benefits. We believe, as far as I know, we have the lowest participating loan rate in the business at 3.7. We can't illustrate that. We can only illustrate 50% difference between what we're crediting and in interest and what we're crediting on their loan, but it is 3.7% participating loan. And 5% PDA if you have a lump sum. We'll guarantee 5% and spread that money in. So we're going to use the accumulator. Accumulator is #1 in the industry, has been for a long time. This is for a 55-year-old. These guys are 65, but you guys get the idea. All the usual suspects. So in this case, if we do the lifetime pay, because they don't want to take that big tax hit over the next 5 years, you can see we're putting in $27,500 a year, which is their guaranteed income benefit minus taxes. Their death benefit is $1 million. $1 million is still better than the 300-something thousand they would get if you did nothing, right? It's less than the 1.25 if they suck it up today and pay some more taxes in the next 5 years. But if they don't want to do that, and you don't want to bump, they're right up against the tax bracket, and you just would rather take the lifetime pay, this is still a wonderful plan. Certainly better than the do nothing plan. Any questions on
Michael, what did you click for the solve to get that death benefit? Did you put in annual premium and then click solve for what? Level, like
Thank
level?
you. So,
yeah.
Yeah. So I solved for, let me go back so you can see the illustration. So I solved for maximum death benefit to, I can't remember if I did age 100 or age 95.
Perfect. Thanks, man.
Yep. I probably did 100 because I want to build some conservativeness into things, rather under promise and overform. But the idea of this is the concept, right? I want you guys to get out of the inherited IRA business and get into the Roth and IUL conversion business. So compensation for this advisor, the total gross GDC or target premium is more than the last one because of this first bullet point. There's an annuity commission on top of it because they didn't want to pay those taxes over the next 5 years. They'd rather spread it out. So you use an annuity and you guys get paid to write annuities. Wonderful. Everybody wins. The point I want to make is this is worth your time. Sometimes we'll talk about ideas that are less sexy than others, but the GDC on this stuff is meaningful. So my pitch to you guys, here's my close. Like you want your clients to walk away with something. I want you to walk away with this, is to have the conversation. And having that conversation involves, all right, so my slide, you can't see this. It didn't blend in, but what were they given or not given? So Mr. and Mrs. Client, have you ever received an inheritance? And it doesn't matter. It doesn't matter what they say. If the answer is yes, you get into that. If the answer is no, you get into that. So if the answer is yes, like, well, how did that affect you? Well, I was able to get a down payment on my house, or I was able to send my kid, my parents' grandkid to college. Whatever it was, there's probably a positive story. I was able to get out of debt, fine. Or if they didn't, what would it have meant to you if you did get something? Oh my gosh, well, I could have had a down payment on a house. I could have paid for my kid's college. I could have whatever. I could have started a business. All these different ideas. I could have bought a house, easy. or supplement their retirement, right? Because sometimes people who inherited IRAs are in their 60s. That's real. right? People die in their 80s and 90s. People inherited are in their 50s and 60s. So the important part is having the conversation. Have you ever inherited money? How did it affect you? If you didn't inherit money, what would it have meant? And then the kicker is, all right, of this plan, what do you want to go to the next generation? What's going to go to your kids? I believe that conversation is not happening as often as it should. And hopefully you're thinking, no, Micah, I talk about that. We get into that. And if that's the case, awesome. Awesome, because you're probably doing this kind of work. If you're not having that conversation, let me tell you, you guys are great at a lot of things. Navigating interest rates and portfolio balancing and different products and different tax rates and all that kind of stuff. But what matters to me is my family and the people that I love most. And all that stuff is important to my plan. But if you're talking to me about what I want to leave to my kids and my grandkids, or you're talking to me about did I ever receive anything and how that might have impacted my life, these are the conversations where I walk away and saying, my advisor cares about me. My advisor cares about my family. I'm going to send you referrals. Oh, by the way, this is really lucrative business for you guys to be doing. So legacy done right is all about identifying the assets. What part of this qualified asset, what part of this qualified money are my clients not going to use? What part of this do they want to go to the next generation? That's the conversation I want you guys to have. So we talked about this with qualified and IRA money, but it can also work with their safe money. Why do people have money in the bank and CDs that they give to their kids? Because they just haven't met with you guys yet. They don't know they can get that leverage if they transfer that CD into a life insurance. And by the way, if they think they might need to touch it just in case, you've got full illness benefits and you could put that in a cash value plan. Maybe next time we'll talk about one with a waiver of surrender charge so they can access it. But there's lots of different ways. The worst thing to die with is a qualified plan. But the second thing, the worst thing to die with is anything else that's not called life insurance, including money at banks. Maybe they had stuff in variable stuff for annuities. Annuities do get left to the next generation as well. By the way, that's taxable, right? Whether it's qualified or non-qualified, at the very least, the gains are fully taxable. Not a very efficient way to leave money to the next generation. Old life insurance plans. Some of the biggest cases that you guys write are old whole life, old VUL that might have made sense way back when, but just things are a lot less expensive. You know, Dane asked me the question, which product did I use for that first one? I used the Protector because it has the most leverage possible in the business. Nothing turns pennies into dollars like life insurance, especially that Protector product. And the last one to put a bug in your head is property. I am 3 of 4. I've got, I'm going to stop sharing here. I've got 3 siblings. If you were to leave money to me in a property, well, let's say we had 3 siblings. You leave property to the next generation. We got 3 siblings. Each one's going to want to do something different. What is one of them going to want to do?
Sell, keep.
Thank you.
Rent.
All right, you got it. Sell, keep, rent. Right. One of them's going to want to sell it because they want the money. The other one's going to want to keep it because they think they can use it as a rental and they think that's a better investment. Or the third one is the one who actually needs a place to stay, right? So there's lots of ways to mitigate things, but the one thing I don't want to leave from my kids is an argument. And so life insurance is a very efficient way to leave money to the next generation. It's got leverage and it fires the IRS. So we started this with, there's a big tax problem and the challenges for our government and what that's going to mean to future tax rates. And I think it's you can't solve that and your clients can't solve it, but it is a great setup to talk about taxes. And the worst thing to leave to your kids is a qualified plan. So what of this plan do you intend to leave to the next generation? We talked about a 5-pay. We talked about a lifetime pay using annuities. And then we talked about the importance of just having the conversation. And the last part is, if you don't have a report that can show this, please use ours. The numbers really help to show, like, if you do nothing, this is the plan the IRS has for you. But if we plan today with Perennial, we can do this. hopefully you guys are walking away with something, but we've got a team here. What follow-up questions
Mike, I
do
got
you
a
have?
question about let's say you do like a 5 pay, right? And I feel like that's the cleanest because, people tend to forget the strategy sounds good. And then like 10 years later, they forgot, what are we doing again? Like, why am I paying this,
Sure.
right? All that kind of stuff. But for a 5 pay, like what would be like the good age? Because if they do it too early, sometimes they don't want to commit too many dollars to the next generation if they may feel like they want to use it, but if they get too old, are they even able to get life insurance? Like, what's in your experience kind of been like an age range that kind of works?
Yeah, what's that sweet spot? That's a really intuitive question and an intuitive setup. You're right. I prefer the 5 pay as well because if you remember those scales, one of the things on this side was like it gets done and it's just finished, right? We can see the end to it, and like Dane talked about certainty. I think clients do like certainty. So that kind of your sweet spot range is your 55 to 70. Now it still works for a 75-year-old.
If I could couple on top of that, the ones that really tend to be a great candidate if they retire at age 60, but don't take Social Security at age 65 or 67 range. That 60 to 65 is such a good sweet spot because if they retired, they're in a lower tax bracket than they were the year before. They're not taking Social Security yet, which can, if they start doing these conversions, can push up the cost for their Medicare premiums. So that 60 to 65 is just tends to be a real, and oftentimes what they can do is if they have a non-retirement account or rental properties, they can kind of for about 5 years kind of use that income or drain down that income, if you will, while you're doing the conversion. So it's really a cool time frame where you can push them into the lowest tax bracket, convert them so that they're not going to be in a higher tax bracket when taking Social Security, taking RMDs, taking distributions out of the IRA, and they're not working anymore. So that's the sweet spot I've noticed for people.
Agreed. That fits right in. And look, the other side of Stan's question is because that sweet spot age, like what Dane was talking about as well, that 55 to 70, but really that the period between 60 and taking between retirement and Social Security, is if you're meeting with their kids and their parents aren't your clients yet. If you're meeting with me, I'm 49 years old. I would be a classic one to ask, Mike, do you ever plan or are you going to receive an inheritance from anybody? And if the answer is yes, I promise you, you would rather be working with my wife's parents that are going to leave me money versus me because they have more money and they need you more. So the other side of Stan's question is asking people my age, do they ever plan on inheriting money? And this is a great way because look, I'd be an idiot not to refer you to my parents or my in-laws because you're going to help maximize what I'm eventually going to get and help them maximize what their goals are for their kids and grandkids.
Awesome job, Mike. This is such good info.
Sometimes, like we'll talk about complex things, and complex is fun, but sometimes we're going to talk about life insurance for life insurance, and this really is the simplest way, but it takes someone having the conversation. And my takeaway from this one is I would love to run a legacy done right illustration for everybody here. If you have someone who does have money that's going to go to the next generation or someone who's going to inherit money, it's just so powerful to show them on one side the IRS plan, on the other side the perennial plan. You don't have to sell anything. It's just math. Like one is just more efficient than the other. And it's lucrative. All right, y'all. I appreciate you bearing with us through the tech stuff this morning. Hopefully you're taking away some ideas that you can go help somebody with and make some extra revenue this year. And man, I love being with the perennial team. So really appreciate you guys seeing everybody.
Thanks, Micah.
Appreciate you, man.
Thanks for the people
send
who
that to Tia,
participated.
me, and Miriam, and we'll upload it. We'll get that on for everybody to access.
Got it.
Thanks, man. Later.
All right.